The rand has held onto most of its recent strength despite a bit of a blip yesterday, which may have been caused by reports that the ANC is investigating a tax on the hot money that has been coming into South Africa. These portfolio inflows have been credited with much of the strength we have seen this year so far. For a closer look at the rand and its drivers, we're joined in studio now by Gable from Absa Capital and Ian Cruickshanks from Nedbank Capital. Gentlemen, thank you so much for your time today. Let's start off with you, Jeff, and just looking at the comments made by the ANC yesterday to tax capital inflows. Do you think that's a wise idea?
Well, let's make it clear. It's a discussion document, and I think it's fair to say that the ANC discussion documents generated quite a lot of discussion already, and the meeting itself is only towards the end of September. So the general problem, and it's not a South African specific problem, the problem that lots of emerging markets are facing right now is, for a host of reasons, they're seeing a wall of money come in. That wall of money coming in is elevating exchange rates, and it's diminishing competitiveness. So different countries are looking at different kinds of solutions, intervening very hard, maybe trying administrative measures, maybe something like a Tobin tax. They're all different answers to the same general problem. What's interesting is when you look at the experiences of Latin America, you look at the experiences of other countries in our time zone, you look at the experiences in Asia, somebody like China, there aren't really a lot of success stories. The wall of money is large, your ability to act against it is fairly modest. You know, at best you can probably lean against the tide.
So Ian, any idea of how successful the Tobin tax has been in Brazil? Because they put in a 2% tax, I think, on portfolio inflows a little earlier this year. Was that instrumental in helping to weaken the real, or is the real strong as well?
It hasn't had an impact on the currency. And I think if that is the intention here, weaken the currency, we've got Kasatu talking about 10 rand to the dollar. That's frightening. That's the way I look at it.
Why is it frightening?
Because of what it will do to inflation. Now, look at it from the other side. What have we gained by a stronger currency? And this seems to be being ignored. One little example. Since the beginning of last year to now, the dollar price of oil has gone up by 186%. Okay? The rand price has gone up by 145%. I shouldn't say 86% versus 45%. Which would you rather have? A stronger currency and a much lower oil price? Surely. Now, I think we look going ahead. We want investment. We want lower cost inputs. Isn't a strong currency going to have a significant impact on that? If we have a weaker currency, inevitably we get imported inflation. We find that there's less job creation and poverty alleviation. The major aims of the government, I think they should stick to what they want to do. Creating jobs is not by making us less efficient, which is what a weaker currency would do. It's a strong view, but I'll stick to it.
Jeff, I'm going to play devil's advocate here, because at the end of the day, when you see what the manufacturers are going through in South Africa, we know that they are significantly under pressure. You know, something's got to give at some point, and yes, maybe the rand at these levels is far too strong for them, but you know, what is the ultimate solution down the line for these manufacturers? Do they just start factoring in a stronger rand, or does it just mean that our manufacturing sector and our exporting sector is just going to become less competitive down the line?
Well, certainly the mapping is sort of quite direct, right? The first impact of a weaker rand essentially increases the rand price of your output as an exporter, so it helps with your mix between costs and revenues. But Ian's mentioned a number of very important things. So long as the weaker rand turns into more inflation, the more inflation turns into higher costs, you kind of get yourself nowhere fairly quickly. For South African manufacturing, the focus needs to be on being as flexible as possible, because we know the rand moves in big ranges, and maybe it's those big ranges and that need of flexibility that needs the focus, rather than it is this sort of simplistic view that somehow 730 against the dollar is the wrong number, but maybe 830 would be our salvation, or 930 would be our salvation. I think the MPC, Governor Marcus, did a very good job when we met just a few weeks ago, and she said, you know what, lots of people tell us where the rand should be, and all the numbers we get are different. They're all sort of weaker, but they're all different. Even if we were to accept we know what the right number would be, we're not sure we could get there. And if we knew what the right number is, and we thought we could get there, we still need to have a discussion around what the costs of doing that would be. So it's far from clear just what policy should try to do here. That said, there certainly seems a big push to do something, and as I started, it's not a South African specific push this time around. Lots and lots of emerging market countries are facing the exact same pressures in trying to find the correct solution.
Of course, Ian, we've had Treasury and the Reserve Bank both saying that the market should decide where the rand is going. What could they do, though, if they did want to weaken it? We've talked about, obviously, the Tobin tax, whether that would be effective or not. And there's all sorts of other measures they could take. We don't really have the forex reserves, though, to really peg the rand, do we?
That's a big problem. And our reserves cover a little bit more than 6 months of imports. That's the bare minimum that a country such as South Africa should have. We can't afford to risk them. I remember that Governor Mboweni used to say that they could lean against the wind, take a little bite now and again. And yes, we do see some signs of that occasionally, but we don't have the firepower, and we really in the reserves. And we have to remember that it's not a very profitable operation. You buy dollars, you get dollar investments yielding 1 or 2%, and it's costing us rand interest rates. So there's a big interest rate cost, which we can't afford. We don't have the backing for it. I think that they simply have to apply patience in the long run. Because of the inefficiencies in the South African economy, we will gradually see a depreciating currency. Give it time, it'll happen. I think that's the...
Let's take a step back. Looking at the global economy, we hear talk that the Fed could, embark on even more stimulus and more quantitative easing. You've got the European Union at this point in time as well under significant pressure. You've got everyone trying to weaken their currency at this point in time. We're seeing incredible flows coming through into emerging markets and South Africa. The Swiss National Bank was burnt extensively by trying to weaken their currency and propping up the euro. I mean, Jeff, when you see it from a global perspective, Ian is talking about having patience. How much patience do we need to have?
Well, it's very tricky. We know that intervening in the market can be costly, and the Swiss got on the wrong side of that. We know that here in South Africa, the more reserves we purchase, not only are we paying an interest rate differential on that, but if the exchange rate does move, that has an impact on the profitability of the Reserve Bank. But those are very specific and direct factors, and I don't think anyone that's suggesting South Africa does something is saying the costs, the first order costs aren't there. What they're saying is that, there's a social impact. There's an employment impact, and we need to think about protecting as much as we can. So as much as sort of orthodox economics would say, no, you must let the currency find its own level, we have to appreciate that we're in an environment where there are a number of issues at play here. The document that the ANC released, there are 5 discussion points in that 19-page document, the 5th one of which is monetary policy. The other 4 have nothing to do with it, but all of which are trying to think of the right solution for South Africa to generate jobs, to get money more equitably distributed. That's what the ANC is trying to get a focus on. And market participants, we're focused on one small part of that, but the problem itself is very large.
What would the cost, though, Jeff, be of a Tobin tax? Because we don't want to really deter those portfolio inflows because we need those to fund the current account, don't we?
Well, the point of a Tobin tax is try to distinguish what sort of portfolio flows you get. So the way that the tax works is that essentially if money flows into the country, it pays sort of a fixed tax amount. Now, if you're trying to make money fairly quickly and run, that tax can be a very large proportion of what you thought you were going to earn with a 1 week or 2 months.
So it's taking some of that yield away that you're getting.
It's taking some of the yield away, but the idea is if you're a medium or long-term investor, as a medium and long-term investor, the returns you're expecting to get are probably fairly large. That tax can be a small part of what you were going to earn. So you may still find the investment case compelling. That's certainly what's happened in the case of Brazil. So what the hope would be behind this is if portfolio flows are this large now, you kind of want to take them down just a little, because we know we need a lot. We need to finance our current account deficit. If you're trying to only work on the margin, that's a very, very difficult balancing act to complete successfully, but that's at least the goal. And for now, in this environment where money is just coming in and in and in Brazil's case, it doesn't seem to have caused much of a problem. It's not obvious what they got on the plus side out of it, but the costs seem to have been manageable.
And let's go back to the notion of trying to create jobs in South Africa. That is the key factor, but we also need to increase productivity. Yes. What is the next step by government? What is it that we need to do to increase jobs? Because if we're not going to be focusing on the rand, and we need to appreciate the fact that it's going to be set by market forces, so we are going to be seeing a stronger rand for some time, let's focus on what we can work on, and that's increasing jobs.
Perhaps we don't necessarily need a government incentive. Perhaps we should see the private sector taking the initiative and saying, with the rand at this sort of level, this is the time to most cost effectively import plant, machinery, all the technical stuff that we don't make here, and bring down our competitive international pricing. That way we could become more significant exporters. By doing that, we'd increase productivity, profitability, job creation, and you get that virtuous circle. It's seen to be profitable, attracts more capital. You've got that virtuous circle of this carrying on. And once that happens, I think we would then have the aim of job creation solved in a relatively short space of time.
Of course, we did have the Industrial Policy Action Plan out a little earlier this year. Is this something that's tackled in there? Is this how government's also seeing it, Jeff?
Well, the trick that we have isn't so much being able to import capital less expensively, which certainly helps business and might help our exports, but what we're particularly concerned about is finding employment. What we're trying to find aren't capital-intensive solutions to this issue. We're trying to find very labor-intensive solutions to this problem. And that's behind the Industrial Development Plan, that's behind all of the planning of economic development. It must be behind all of the policies of government in general. I don't think we're there in terms of a solution yet. It's a very difficult issue when we look at the labor force that's out there. The labor force that's out there may not get paid very much, but what we see from the employment stats is it's getting paid too much compared to its global peers. That's a horrible message to tell anyone who's sitting there on a low wage right now.
Looking at the rand at this point, where do you see it going from here onwards, Ian? And given the fact that we are expecting more currency depreciation from the major economies, the US and of course Europe as well.
I think it's going to hover in this, let's say broadly, 7 Rand to 7 Rand 50 or 60 or so level for a while. A while, maybe a few months. 3 months in the South African forex market is quite a long time. But I think that by the end of the year, we would say not weaker than 8 Rand to the dollar. With the risk being, it could be on the stronger side of it. I think it would be very unlikely to strengthen a lot below 7 Rand. We've got a depreciating cycle that goes back about 6 or 7 years, and we're on that line now at plus or minus 7 Rand. I don't think it's going to turn around right now, so I would say that's the target.